Congratulations, you've hit that $100,000 milestone. Now, what exactly do you do with it? Regardless of if it was a windfall from lottery or if it was an inheritance or slowly steady building it over time like I did, you're going to have the opportunity, and this is the biggest opportunity to start building long-term wealth. When we start thinking of this, the assumption is you are already on solid ground when it comes to finances. That means that 100,000 is above and beyond and eliminated all of that high interest debt, and you have that cash cushion to cover that emergency fund. So let's go ahead and get into this. When it comes to that $100,000 and starting to invest it, there's a couple things to really be excited about, but a lot of people can feel very overwhelmed. When it comes to investing, a lot of people, it is super confusing. It's way too complex. They do not want to leave it to anyone but professionals, which is the first one, deciding how you want this money to be managed. Now, for this one, we have three different options. Number one, I want to manage the investments myself. That is the easiest way to do it if you do want to put in the financial time, understanding the markets, knowing exactly what you're invested in. And this, of course, you're going to have to start a brokerage account. I use M1 Finance. We have some links down below. Also do have Robinhood down there if you want to do some of that self-investing, taking the funds, depositing it into those accounts. Then you pick your variety of assets, whether it's stocks, bonds, mutual funds, ETFs, index funds, cryptocurrencies. That's where the confusion can come in, is where exactly do you want to put it? Making sure that you're well diversified, that you have a portfolio that is within the risk tolerance in your DIY routine. And of course, I do have a couple videos out there with the 3 ETF portfolio that I chose. Now, the second way to do this, automating the process. This is robo-advisors. If you're unfamiliar, a lot of AI, a lot of automated portfolio management systems will and be a lot cheaper than humans actually interacting with it, but it doesn't have a human touch to it. Meaning, if you actually want to talk to someone, if you want to ask questions, a lot of it is very automated, meaning your money can actually just be taken and put into directly into portfolios with a bunch of other people, kind of crowdsourcing all of the money together that they're investing into these portfolios. And they just ask you a lot of questions to figure exactly where your risk tolerance is and what you're looking to get out of this. And the last one is full service guidance. We are talking about hiring and paying a financial advisor. This is someone, if you want to talk to, is going to make and really manage the money, address any financial questions, address any concerns, and really planning is the big thing that they do, considering going above and beyond that robo-advisor to have an actual financial advisor. This could be in your bank, could be in your credit union, could be a lot of other places that you can find financial advisors. But you do also have to be cautious because there is a charge and there can be a lot of fees depending on the advisor you get. The second one we look at is padding your nest egg. This one, very important. You determine exactly how you want your money to be managed, how and what time you're going to start putting that money in the market. What's it going to look like? Now, with that $100,000 lump sum, you have really the ability to pad a lot of other things financially without just throwing it into the market. Perhaps the question is coming, with this money, we can do X, Y, Z. Let's say paying for the kids' education, getting everything set. You could be looking at scholarships. You could be looking at retirement planning, making sure you have enough money. There's a lot of different things you can do, but making sure that you're not sacrificing your own retirement for the benefit of other individuals. As much as I would love to pay for my kids' education in its entirety, it is very expensive. And if I sacrifice my retirement, there's going to be years when I do need the money and might not be there because we spent it for other things. Now, third one, maxing out your retirement accounts. This again is very important. With that $100,000 at your disposal, you have the ability to max out your 401k plans and your IRAs. This is really the ability to pay or really avoid the IRS in the future. Now, when we start thinking about those employer-sponsored retirement plans, your 401ks, your 403bs, individual retirement accounts, whether they're Roth or traditional, which in my opinion, always do the Roth variation, you can really shield hundreds or $100,000 that you're putting in there, which of course is what we're playing around with. You could go in there making your contributions. Now, 23,500 for 2025 is the max contribution. If you're age 50 and older, you can put an extra 7,500. And due to the Secure Act 2.0, you can actually 60 to 63, you have a higher contribution up to 11,250 for the catch-up contribution based on how much and when you're getting ready to retire. Now, of course, you can't put 100,000 lump sum in there. There are caps, but over a couple years, you could take that $100,000, maxing out the 401k in the entirety and maxing out the contributions. Now, of course, when it comes to contributions, focusing on handling taxes now. This is the reason with that $100,000 and having that lump sum, you want to make sure that you're getting rid of or eliminating as much tax and keeping as much money as you can. There are some immediate things you have to do when it comes to the IRS. Now, there's two real scenarios in here. If you didn't inherit it, let's say you got a 401k when you left a job. If you took the $100,000 out of an older 401k, you only have 60 days to replace the funds. You have to know this because that money has to go back into a Roth IRA or traditional IRA, depending on what the 401k was. Otherwise, you have to pay a hefty bill. And there could also be not only tax ramifications, there could also be a 10% early penalty if you took the money out of IRA accounts. If it's an inherited IRA, little bit of a different guidelines, but there is also tight guidelines with those, or deadlines as they put it, rules that beneficiaries can do and can't do, exactly how it has to be handled. Now, number 5, stay vigilant about fees. This is the big one, like we said, with financial advisors, but also with the IRAs. We don't want everything to be eaten up in fees. Not, every dollar that you're handing over to the IRS is something, and a dollar that you're not going to get back. It's a dollar that you're not going to have for your future, that has no chance of compounding in the future, which is the reason when you start looking at small fees, it is going to take a bite out of your investing. This is the reason why we talk about index funds, investing in that 3 ETF portfolio, looking at exchange traded funds versus mutual funds, and doing it yourself versus the financial advisor. Is possibly in the future, you start looking 20, 30, 40 years down the road, you could be giving out hundreds of thousands of dollars that has been in growth from the time you invested that $100,000 in essentially upfront because of what you have going on. Now, the last one that we're going to look at, reallocating your portfolio. With your money in hand, it's a great time to review your portfolio. And again, kind of 3 points in here, taking an asset allocation snapshot, look at your investment mix, make sure the diversification has not changed. What are you holding in current 401ks, for old 401ks, IRAs, brokerage accounts, bank accounts? Make sure you have it aligned with the time you plan to leave your money there, and also knowing what kind of risk you're taking and how much risk you're taking. When you think about a larger portfolio, putting an incredible lot of money into something that is very low risk, you might not see the growth that it needs. And also moving it to something that is low risk during retirement years, again, you might not see that growth that we see out of there. Now look at and identify areas where portfolios become unbalanced. The amount of money that you have in stocks versus bonds, make sure you know exactly the mix, because most of the time when you start getting a little bit closer to retirement, you want to start putting more into bonds. Now, personally, and a lot of articles have come out recently talking about that you don't want to move too much of the money, because when you start retiring, let's say you retire at 62, start drawing Social Security, you still might have another 20, 30 years of life that you could get growth out of this portfolio versus putting it in bonds, which has been running about a 2% return. And the final one, consider asset location. This is another one when it comes to tax diversification. 401ks, IRAs, if they have a tax deferred angle, you can definitely do that. We have seen an incredible amount of IRA money being moved over to a Roth IRA, and it's kind of been crazy because we have seen it faster than we ever have in history, because those investments will grow absolutely tax-free. If it's money that you're not going to use, if it's forever money, if it's money that essentially is going to be left to your heirs, there's no point you're going to use it, you could make a really big move and start slowly moving over and getting that money into a Roth IRA versus having it in traditional, and then they're not subject to RMDs, and you can also take tax-free withdrawals out of there in the entirety. So guys, a couple interesting way, and the best way really to invest that $100,000 depends on your personal situation, different types of accounts, different types of time frames, and knowing your investments, your taxes, what you're going to have to pay, possibly the fees that you can see will make a really big difference. All right, so that's going to do it for today's video. Let me know in the comments what you guys think, and as always, thank you guys for watching.